Welcome to a video where we talk about how to create a financial business plan to start a nail salon. In this video, we are using one of the financial model templates from efinancialmodels.com. Please also consider subscribing to our channel as we will upload more videos about financial planning and financial modeling. Our nail salon will sell different types of services at different price points. Normally between half an hour or 1 hour, where the client walks in, sits down, and then basically gets her nails done. So the question is, if you sell these types of services, how will your business plan and financial plan look like? For this, we have two types of planning frameworks we have to look at. One is a multi-year financial plan, so that we can get more clarity on how much revenues, costs and profits then will result if you look at it from an annual planning point of view. And the other planning horizon is more short-term, especially we need to look at it on a monthly basis. Once we start the business, we want to know, are we on track in our plan? And we also want to simulate how a start of this business realistically might look like and what are the costs to start this business. Then we also need to calculate or see the effect on a cash basis in terms of the cash flows, how much will be the if there will be some positive or negative cash flow generated. Maybe at the beginning it might be negative, so the question is how long will it take to get them to positive. Then also how much funding will be required to get the business started. And then also, if you look at it from a cash flow basis, this is an investment, so if you have to invest, we also need to answer the question, by when do we think we can get the money back? That will be called the payback period. There are also other financial metrics we are interested in, or also we want to calculate so that we are prepared for a discussion with a bank in case we need to obtain bank financing. In preparing a financial plan for a nail salon, we need to work through a set of assumptions. This template already has various assumptions pre-configured, so I will not go into every detail. I will just focus on the main points which are really essential when you want to plan out how your nail salon can take shape. When we want to estimate the revenues, then we need price and volume. So at one point we need to define what kind of services we are going to sell and also at which price points. Then for the volumes, these are basically the number of services sold. Here we estimate this number on a monthly basis. And what we're doing here is to reflect an increase in the number of services sold. And then the question is at how many services per month will our business be stabilized and going forward. And as you can see, the easiest is if you just estimate the overall number and then here allocate the percentages, what type of service exactly is being sold. And here you can also see there might be at the beginning more cheaper services, and then once the clients get to know you a bit, you might also be able to sell more services at the higher price points. And this is what we are basically want to reflect and we need to think about when we collect the assumptions. Then the next area of interest are the direct costs. The question is, if we sell to clients, in case most of the clients pay via credit card, are there any payment processing costs we have to take into account? Then also, in case sometimes we have partners working with us, there might be a fee share we have to consider. So those are all costs as expressed as a percentage of revenues which we should estimate. Then the other area of direct costs are the material costs. Here the question is, if we sell a certain type of service, what are the material costs we have to take into account? And then we already have the direct cost, variable cost, what we need to finish or basically to complement our forecast are the fixed costs. First, we take the fixed cost on a yearly basis. We need to work through how much we're going to spend for rent, for our owner's salary, the employee's salary. The question is how many employees we are planning to, or we require if we want to, if we see that the market allows us to sell, for instance, here 500 to 600 services per month, how many employees do we really require? And then we have to take into account their salaries. In addition, also all the other cost position which might come up, so that at the end of the day we have here a fixed cost, a clear budget of the foreseeable fixed costs. Then in order to start the company, we might have also some investments at the beginning to do. This is called capital expenditures, CapEx. This is mostly costs we have to incur upfront for new equipment, fixtures, or maybe even to buy a property in some cases, intangible assets, permits, licenses. So these we have to basically investigate how much these costs are going to be. There might also be setup costs, costs to establish a company. Then when we start selling the services, we might have to wait a certain time until we get the money, and this is called receivables. So the question is, how much do we have to plan for? How much of our capital will have to be invested in these receivable positions? How much in inventory? Then there might also be rental deposits or other items we have to take into account. And then in addition, also we might need a liquidity reserve so that we are always liquid in case it takes a bit longer, that we don't run out of money. So that's a bit the budget we need. Then another question might be how much bank financing we can obtain. We can start with a certain assumption, or we can come back later and see how much funding this business plan might allow to obtain. What we want to do next is to review first our multi-year financial plan. We will first check if the number of services sold, if this is going to change, or as assumed here is basically expected to be stable going forward. Then in terms of the prices, the question is there any effect from inflations, or are the prices going to be the same? So that we have basically both parameters we need, and we also need to understand how these are going to develop over the next years. The next topic to look at would be the direct costs, but here this is pretty easy. We keep the costs as they are. We don't have any other, unless we have any other information, they should basically be the same, and they should only be affected by the expected inflation, so that we have to reflect that in the direct cost assumptions going forward. Then of course there are also the other assumptions, maybe also to mention some of the CapEx which is needed, so to maintain the good status and functionality of the equipment we have, but this is basically should be pretty straightforward, as is a cash expense. Then we also have to think about if we take on debt bank financing, what will be the required repayment schedule. And here we need to prepare a plan in which years we are going to repay how much of the financial debt. And as you can see here, this is a 5-year repayment plan, which basically a bullet payment here at the end. What we are interested in is to calculate at the end the debt service, which is the repayment plus the interest, so that we know this is what we need to ensure that we can pay this to the bank. Then the next topic to look at are our projected annual financial statements. We have here, we need a profit and loss statement forecast, a balance sheet forecast, and a cash flow statement forecast. The key points here are that we want to know what will be the required revenues for our business plan, what will be the projected EBITDA, And of course, this has to be positive so that we have a viable business, and the same also for the net profits, which should also be possible for the same reason. The balance sheet basically serves the purpose that we have a more complete picture about our business in general, and it allows us also to calculate the forecasted financial ratios. The cash flow statement is needed so that we can have a closer look at the cash flow from operations, which should turn positive quite soon. We also then want to make sure that after paying for the financial debt, that we have sufficient cash, and that also our cash balance end of the year will always be positive, so that we don't get into any troubles. As you can see, we also have here calculated all the financial ratios you can think of, starting with the growth figures, profitability, the efficiency, but also financial ratios which might be of relevance to the banks. What is the multiple of the envisaged debt financing related to EBITDA? Can we service the debt from our cash flows? Is our interest covered by the profit? So these are kind of ratios we want to look at and understand so that we have a good argumentation basis when talking to the bank. Another area you might be interested is, that's more a hypothetical simulation at this point, but still we want to make a simple valuation going forward. And we can do this by taking the EBITDA and apply a multiple, so that gives us an indicative value what this business might be worth some years down the road. Then we also calculate here the free cash flows. We do this for two types of cash flows, and assuming that we'll calculate this for a period of about, in this case, between 5 to 10 years, in this case 10 years. And we want to know, if we don't use debt financing, what will be our cumulative free cash flows and also the annual free cash flows. And if we take into account debt financing, what will be the cash flows which are basically available to the equity shareholders. And doing all this allows us to calculate the financial metrics, which can tell us more about the quality of our plan. For instance, how much financing is required on an unlevered and on a levered basis. Other financial metrics we want to look at are the internal rate of return, here calculated based on a 10-year holding period. We also want to understand then cash on cash yield, the relationship between the annual cash flows and the initial investment made. And we also want to understand the payback period, which gives us the relationship how long it will take to recover the initial investment. This financial plan has been made based on a 5-year monthly plan and then aggregated into a yearly plan and extended for another 10 years. So we have basically all details at hand so that we can get a comprehensive picture about our plan for our nail salon. We also need some sort of executive summary, in this case summarizing the budget, the monthly budget for the first year, the build-up of the services, the prices sold, and then also the revenues and their breakdown, especially in the first months, to see if we get comfortable with this plan. But as said, we also need the big picture. We also need to know what's going to happen over the next years, and if the cash flows are sufficient to also pay back the targeted debt financing. So another question might be in terms of the risk. We also want to understand the break-even point for our business. In this case, we can look at either do a calculation for the first year or for the second year. And there are basically two questions which are of relevance. In this case, if we have the number of services given per year, what would be the required average order value so that we can get to break even. As you can see here in year one, we are a bit short, so that our business plan is a bit lower than what is required to reach break even. This is mostly due to the initial months where we are just starting operations. So for this reason, it might make more sense to look at the second year, and in the second year we can see that our business plan clearly is above the break-even point. So the difference basically here is the amount of profits we are going to make. So that's one way to look at in terms of the price. The other one is, let's say if the price is a given, then we need to know how many services do we need to sell in order to get to break even. And here what you can see is that in the second year our business plan is higher because we're assuming that we can sell more services than what is required to reach break even. So also this type of analysis can be included in your overall assessment of the financial feasibility of this nail salon. I hope this video gave you a good overview how to do a financial business plan for a nail salon. If you found the video useful, please give it a thumbs up, subscribe to our channel and visit our website efinancialmodels.com. A link to the financial model template used in this video is included below. Thank you for watching.